Marvell Technology, the fabless chip maker, reported third quarter 2024 earnings November 30th. Revenue did come in lower by 7.7% to $1.4 billion, but it was still ahead of Wall Street expectations. Gross margins were just 39%, the lowest in at least 2 years. Other key line items in the financial statements all came in negative, with operating profit reporting down to negative $146 million, pre-tax income at a negative $188 million, and net income at negative $164 million. The company has a market cap of $45 billion. Their two largest end markets, data centers and enterprise networking, saw year-over-year declines by 11% and 28% respectively. These two revenue channels made up 58% of total revenue, down from 65% of total revenue. The company cited a tough business environment for the decline in sales. However, a report by McKinsey posited that U.S. data center demand will grow by 10% per year until 2030. NVIDIA recently announced a partnership with Marvell, so perhaps the data center revenue decline is just a blip this quarter as energy costs hit hosting more than expected. Carrier infrastructure business was up 17% year over year, though the consumer business was lower by 5%. Marvell's auto segment was the fastest growing business, up 26% year over year as cars become increasingly smarter and tied into the grid. Well, let's look at some of the company's financial ratios. Year over year share growth was up 4.2 million, which will have a small negative impact on per share ratios. Earnings per share were negative 19 cents. Sales per share at $1.60 were down 8%. Cash per share was largely unchanged at 84 cents, while book value was lower to $17.66. The negative PE, of course, isn't meaningful. Leverage ratios. The debt ratio to 0.19 is good. Debt to equity is 0.27, still favorable. Interest coverage isn't meaningful as EBIT was negative. The company has a good short-term liquidity profile with the current ratio at 1.58, a quick ratio of 1.03, and a cash ratio of 0.39. Current liabilities were down as the company largely eliminated its short-term debt. Marvell has an equity multiplier of 1.43, return on assets and return on equity both coming in negative, however. Turning to cash flow, operating cash inflow of $500 million were improved by 22%. Investing cash outflows were just $55 million. Financing cash outflows were $146 million, and total free cash flow to the firm was $726 million. Marvell Tech is paying 6 cents per share in dividends, which is a 0.46% yield and a 1% growth rate. The company has an enterprise value of $48 billion, which is 8.5% times annualized revenue and 16.6 times annualized free cash flows. The company provided a guidance of $1.42 billion in revenue for the next quarter, which is the same year over year and quarter over quarter. A better gross margin to 50%, which just means that its cost of goods sold will be lower, and EPS of minus 3 cents to plus 5% per share were in the guidance. Key takeaways on the pro side are that liquidity ratios are good, they have positive free cash flow, and they have industry-leading customers. On the con side, margins are lower, revenues are declining, and the semiconductor industry is very competitive. Our rating on this company is neutral. Like and subscribe.